There is a number that most people never see. It does not appear on stock tickers, it is not discussed on the evening news, but it governs virtually everything in the financial system, from the price of your home to the value of your retirement portfolio. That number is global liquidity, and right now, by nearly every credible measure available, it is flashing signals that have not appeared since the most volatile episodes in modern financial history. As of February 2026, the world sits at the intersection of record sovereign debt, a $16 trillion repo market that the Financial Stability Board has just flagged as a systemic risk, equity valuations not seen since the dot-com era, and a $9 trillion wall of United States Treasury debt that must be refinanced this year alone. This is not speculation. These are the published figures from the International Monetary Fund, the Federal Reserve, the Congressional Budget Office, and the Bank for International Settlements. What happens next depends on how well you understand the mechanics underneath and how early you prepare. Let us start with the architecture. Liquidity, in its simplest form, is the availability of money and credit flowing through the financial system. When central banks expand their balance sheets, when governments issue debt and spend, when banks lend freely, liquidity rises. Asset prices tend to follow. When that flow contracts, everything tightens. Credit becomes scarce, borrowing costs climb, asset prices decline, and the weakest participants in the system begin to fail. The global economy has been operating for nearly 15 years on an extraordinary expansion of central bank balance sheets and sovereign borrowing. Between the end of 2005 and December 2025, the Federal Reserve's balance sheet alone grew from approximately $800 billion to roughly $6.5 trillion. The European Central Bank, the Bank of Japan, the Bank of England, and the People's Bank of China followed similar trajectories. Combined, the major central banks injected tens of trillions of dollars, euros, yen, and yuan into financial markets. That era is now structurally shifting. In December 2025, the Federal Reserve formally ended its most recent round of quantitative tightening, ceasing the runoff of its balance sheet after reducing it from its pandemic peak. The Fed now holds rates at a range of 3.5% to 3.75%, with its own dot plot projecting only a single additional rate cut through the end of this year. While the end of quantitative tightening stopped the bleeding in terms of reserve drain, it did not restore the reserves that were already removed. The Fed's own economists published a note in January 2026 warning that liquidity conditions are subject to sudden changes arising from movements in both supply and demand for reserves. In other words, the central bank itself is acknowledging that the plumbing of the financial system is more fragile than the headline calm might suggest. Michael Howell, the founder of Cross-Border Capital and widely regarded as one of the foremost authorities on global liquidity cycles, has tracked what he describes as a 5 to 6 year liquidity cycle that governs the rhythm of financial markets globally. His analysis, published in late 2025 and reaffirmed in early 2026, points to a critical conclusion. The global liquidity cycle appears to have peaked in late 2025 or very early 2026. If Howell's framework is correct, and it has been remarkably consistent over decades, the implication is that risk assets, including equities, real estate, and speculative investments, face headwinds for the next 2 to 3 years as the downward phase of the cycle takes hold. This does not mean a crash is inevitable tomorrow, but it does mean the tailwinds that lifted markets so generously are now fading. Now let us examine the specific pressure points. The first and arguably most significant is the United States Treasury refinancing wall. As of early 2026, roughly $9 trillion in Treasury securities are maturing this year. That is $9 trillion in debt that must be paid back and simultaneously reissued to new buyers, all while the federal government is projected to run a deficit of $1.9 trillion for fiscal year 2026, according to the Congressional Budget Office. The national debt now stands at $38.56 trillion. Interest payments alone have crossed $1 trillion annually and are projected to reach $2.14 trillion by 2036. The sheer volume of new supply entering the bond market creates a problem. Who is buying? Foreign central banks, once reliable purchasers of treasuries, have been reducing their holdings. The Federal Reserve is no longer expanding its own treasury portfolio. That leaves domestic buyers, pensions, money market funds, and banks to absorb an unprecedented flood of government paper. If demand does not match supply, Treasury yields must rise to attract buyers. Rising Treasury yields tighten financial conditions across the entire economy because virtually every other interest rate, from mortgages to corporate borrowing costs, is benchmarked against them. The second pressure point is the repo market. On February 4, 2026, the Financial Stability Board published a detailed report flagging vulnerabilities in the $16 trillion global market for government bond-backed repurchase agreements. Repos are the circulatory system of modern finance. Banks, hedge funds, and financial institutions use them for short-term funding by pledging government bonds as collateral. The FSB found that leverage, demand, and supply imbalances, and high levels of concentration within repo markets have the potential to create systemic stress. Government securities are used as collateral for approximately 80% of all repo transactions. If the value of those securities declines, or if counterparties become unwilling to lend, the entire short-term funding market can seize. This is not theoretical. It happened in September 2019 when overnight repo rates spiked to 10%, forcing the Federal Reserve to intervene with emergency liquidity. The conditions that caused that event have not been structurally resolved. They have, in many respects, worsened, given the vastly larger volume of government debt now in circulation. The third pressure point is credit markets. As of mid-February 2026, corporate bond spreads are widening. High-yield spreads have stopped tightening and are gradually expanding, even as equity indices hover near cycle highs. Investment-grade spreads are showing subtle signs of strain in consumer discretionary and industrial sectors. S&P Global Ratings reported in January 2026 that it expects only 4.8% growth in global bond issuance this year to $10.8 trillion, noting that strains persist. Over $100 billion in commercial mortgage-backed securities loans are maturing this year, and Morningstar estimates that more than half, roughly $57 billion, are likely to face default risk. The broader commercial real estate maturity wall stands at approximately $539 billion for 2026, well above the 20-year average of $350 billion. Corporate refinancing is increasingly concentrated in lower-rated segments, and much of the new debt issuance is being used simply to roll over existing obligations rather than fund growth. This is a hallmark of late-cycle behavior. The fourth pressure point is equity valuation. The Shiller cyclically adjusted price-to-earnings ratio for the S&P 500 stood at approximately 39.8 as of early February 2026, the highest level since the dot-com peak in September 2000. The Buffett indicator, which compares total United States stock market capitalization to gross domestic product, sits at approximately 220%, a level that Warren Buffett himself once described as signaling that the market is playing with fire. According to Advisor Perspectives, based on January's S&P 500 monthly data, the market is overvalued somewhere in the range of 123 to 201%, depending on the indicator used. None of this guarantees a near-term crash. Valuations can remain elevated for extended periods, but they do compress the expected forward returns over the next decade and dramatically increase the severity of any correction triggered by a liquidity event. Now, understanding these dynamics is valuable only if you know what to do with the information. The first practical step is to stress test your own financial position. Examine your exposure to debt. If you carry variable rate obligations, whether a mortgage, business line of credit, or margin loan, understand that rates may not decline as quickly or as far as markets had previously priced. The Federal Reserve's own projections suggest only modest easing ahead. Reducing reliance on variable rate debt or locking in fixed rates where possible is a prudent form of insurance. The second step is to evaluate your portfolio for liquidity mismatches. In a tightening liquidity environment, the assets that suffer most are those that are difficult to sell quickly. Illiquid private equity positions, thinly traded small-cap stocks, speculative venture investments, and certain real estate holdings, particularly commercial properties with near-term debt maturities. Building a liquidity buffer, ideally 3 to 6 months of expenses in cash or near-cash equivalents, provides the financial breathing room to avoid forced selling at precisely the wrong time. The third step is to reassess your equity allocation through the lens of balance sheet quality. Companies with robust cash flows, low debt-to-equity ratios, strong interest coverage, and minimal near-term refinancing needs are structurally better positioned to weather tighter financial conditions. Technology and healthcare companies with net cash positions tend to be more insulated than cyclical industrial or energy firms with high leverage. This does not mean abandoning equities, but it does mean being selective and understanding what you own. History shows that during liquidity contractions, the dispersion of returns between high-quality and low-quality companies widens dramatically. Owning an index and assuming all constituents will perform similarly is a mistake during these periods. The fourth step is to understand the role of government bonds in a portfolio, which becomes more nuanced in this environment. Normally, Treasury bonds serve as a safe haven during equity volatility, but when the supply of government bonds is surging, as it is now, their prices can decline even during periods of market stress if buyers demand higher yields to absorb the supply. The traditional 60-40 portfolio split between stocks and bonds may not provide the diversification benefit that investors have historically relied upon. Consider shorter duration bonds that are less sensitive to interest rate movements, or Treasury inflation-protected securities that guard against the erosion of real returns. For investors outside the United States, the dynamics are both similar and distinct. In Europe, the European Central Bank just enhanced its euro liquidity backstop, expanding its repo facility to be permanently available to central banks globally with a capacity of up to 50 billion euros. This signals that European policymakers are preparing for potential stress in cross-border funding markets. Eurozone investors should watch for widening sovereign spreads, particularly in higher debt peripheral economies, as the ECB continues unwinding its own pandemic-era bond holdings. In the United Kingdom, persistent inflation and fiscal constraints limit the Bank of England's room to ease, creating a potential squeeze for British households and businesses reliant on cheap credit. In Russia, isolation from Western capital markets has created a parallel but equally severe liquidity challenge, with the central bank managing capital controls and elevated interest rates to stabilize the ruble and control inflation. Investors in each of these regions must calibrate their strategies to local conditions while recognizing that global liquidity is interconnected. A disruption in the U.S. Treasury market reverberates through London, Frankfurt, and beyond within hours. From a tax and legal perspective, those who anticipate volatility should consider the timing implications of capital gains realization. In the United States, holding assets for longer than 12 months qualifies gains for long-term capital gains treatment, which is taxed at significantly lower rates than short-term gains. If you are considering rebalancing your portfolio, doing so before a downturn locks in gains at favorable rates, while selling after a decline may generate losses that can be harvested to offset future gains, reducing your tax liability by up to $3,000 per year against ordinary income with the ability to carry forward unused losses indefinitely. In the United Kingdom, the annual capital gains tax allowance has been reduced in recent years, making timing even more critical. In Canada, only 50% of capital gains are included in taxable income, but the absolute amount can still be substantial on large portfolio moves. European tax treatment varies by country, but the principle remains consistent. Proactive tax planning during periods of anticipated market transition can meaningfully improve after-tax returns over the subsequent decade. Looking further ahead, the structural picture is defined by one overriding reality. The world has accumulated more debt, both public and private, than at any point in human history. Global debt now stands above $315 trillion, representing more than 235% of global GDP, according to the IMF's latest global debt database. The IMF projects that global public debt alone will surpass 100% of GDP by 2029, its highest level since 1948. This debt can only be serviced in three ways: through economic growth that outpaces the cost of borrowing, through inflation that erodes the real value of the debt, or through financial repression in which interest rates are artificially held below the rate of inflation, quietly transferring wealth from savers to debtors. Each of these paths has distinct investment implications. Growth-led resolution favors equities and real assets. Inflationary resolution favors commodities, real estate, inflation-linked bonds, and tangible assets. Financial repression punishes cash holders and conservative fixed-income investors. The most likely outcome is some combination of all three, deployed at different times and in different proportions across different economies. The critical discipline is to avoid two opposite errors. The first error is panic, liquidating quality assets at depressed prices based on catastrophic predictions that may not materialize in the timeline feared. The second error is complacency, assuming that because markets have recovered from every prior crisis, they will do so on your personal financial timeline. Both errors are rooted in the same flaw, a failure to distinguish between what is probable and what is possible, and a failure to size positions accordingly. The investors who navigated 2008, 2020, and every other liquidity event most successfully were not those who predicted the exact timing of the crisis. They were those who held high-quality assets, maintained adequate cash reserves, avoided excessive leverage, and had the emotional discipline to act rationally when everyone else was acting on fear. The data does not lie, and the data right now is painting a consistent picture across multiple independent indicators. The liquidity cycle appears to have peaked. The Treasury refinancing wall is historically unprecedented. The repo market has been flagged by the world's foremost financial stability watchdog as a systemic vulnerability. Credit markets are signaling caution that equity markets have not yet acknowledged. Valuations are at levels that have historically preceded extended periods of subpar returns. None of this is a prediction of imminent doom. It is a description of the environment in which you are investing, borrowing, and building your financial future right now, in February of 2026. The window to prepare is before the disruption, not after. And the preparation is not glamorous. It is paying down debt. It is building cash reserves. It is owning quality over speculation. It is diversifying across asset classes, currencies, and geographies. It is understanding that in a world drowning in debt, the most valuable asset you can own is financial flexibility. The next liquidity shock will not send a calendar invitation. It will arrive, as they always do, on a day when most people believe it cannot. The question is not whether you can predict that day. The question is whether, when that day comes, you will be standing on solid ground.